Two men won the Nobel Prize for a formula that made losing money almost impossible. 11 months later, they lost $4.5 billion and nearly took the global financial system down with them. They weren't gamblers. They were the people who taught the world how not to gamble. Nobody stole anything. There was no fraud. They were, by almost any measure, the smartest people in the room. In any room. And that is exactly why they failed. Because the most dangerous moment of your life isn't when you're wrong. It's when you're certain you're right. And you have the credentials to prove it. This is long-term capital management. And it's really a story about you. To understand the fall, you have to understand how high they stood. The fund was called Long-Term Capital Management, founded in 1994 by John Meriwether, a legendary bond trader who had made Salomon Brothers hundreds of millions. But Meriwether didn't just want traders, he wanted minds. So he recruited Robert Merton and Myron Scholes, two of the most important economists alive. Their work on pricing financial risk was so foundational that in 1997 it won the Nobel Prize. Think about what that means. This was not a room full of reckless gamblers. This was arguably the greatest concentration of financial intelligence ever assembled in one company. Banks lined up to hand them money. And here is the first trap, one you already know. Think of the smartest person you've ever met, the brilliant doctor, the genius engineer. Now remember the time they gave you terrible advice about something outside their field, with total confidence. We assume intelligence in one place means good judgment everywhere. It doesn't. The partners had proven they were brilliant. They, and everyone around them, quietly concluded that meant they could not be wrong. That belief was about to cost them everything. So how did they make money? Imagine two coins that should be worth exactly the same, but one sells for 99 cents and the other for $1. The gap makes no sense, and sooner or later it has to close, so you bet that it will. Each bet earns you a single cent, almost pointless, unless you make that same bet millions of times with billions of borrowed dollars. That was LTCM. Their models hunted tiny, irrational gaps in the world's bond markets and bet enormously that the gaps would close, and they did. The returns were staggering, around 40% a year. For 3 years, the machine simply worked. And this is the second trap. When something works again and again, you stop asking why it works and start believing it always will. Think of driving home on a road you've taken 1,000 times. You stop checking, you stop paying attention. The repetition feels like safety, but repetition isn't proof. It just means it hasn't failed yet. LTCM's models had never been wrong, so the partners decided they never could be. And they borrowed more. This is not new. In 1720, Isaac Newton, the most rational mind of his age, invested in the South Sea Company. He made a quick profit and sold. Then he watched the price keep climbing, watched ordinary people get rich and couldn't stand it. So he bought back in near the top and lost a fortune. Afterward, he reportedly said, "I can calculate the motion of the heavenly bodies, but not the madness of men." Newton couldn't save Newton. What chance did anyone else have? For 3 years, the gaps always closed. The models assumed they always would, because history said so. Their formulas calculated that a loss big enough to destroy them would happen maybe once in several billion years. Once in billions of years. Sit with that. When your own math says something is essentially impossible, you stop preparing for it. You don't insure against the sun not rising. Then, in August 1998, the sun didn't rise. Russia defaulted on its debt. It simply refused to pay. And around the world, panicked investors did the one thing the models said they'd never all do at once. They ran for safety. Together, immediately. The tiny gaps that were supposed to close didn't. They exploded wider. Every position moved against them at the same moment. The scenario their Nobel-winning formula had ruled out as impossible was now on every screen in the building. And here's the quiet trap. It's not that they ignored the risk. It's worse. Their model was so good, so trusted, that it had taught them the risk wasn't real. The better your map, the more you trust it, and the less you look out the window. They had the best map ever built, and they drove straight off a cliff it didn't show. Here is the moment any reasonable person stops. The losses were mounting. The smart move, the obvious move, was to close the positions, take the loss, walk away alive. They didn't. They doubled down. They saw the market moving against them and decided the market was wrong, that it would soon come to its senses. So they borrowed more to bet harder on being right. Why would the smartest people in finance do this? Because you've done it too. You've waited 20 minutes for a bus when walking would have been faster. But leaving meant admitting the 20 minutes were wasted. You've sat through a terrible movie because you'd already paid. You've stayed too long in a job, an argument, a relationship, not because it was working, but because you'd already given it so much that quitting felt like defeat. Psychologists call it escalation of commitment. The more you've invested, the harder it is to admit it was a mistake. So you invest more. The partners had staked their reputations, their fortunes, their identities as the smartest men alive on being right. Admitting they were wrong wasn't just expensive, it was unthinkable. So they kept digging, and the hole got deeper by hundreds of millions a day. It's the same machinery, running the same direction, in all of us. The size of the bet changes. The mind making it does not. LTCMs was simply the largest bet ever made, and in September 1998, it came due. By September 1998, it was over. In weeks, long-term capital management had lost more than $4 billion. It was nearly worthless, but the fund was so large and so tangled with the world's biggest banks that its collapse threatened to drag them all down with it. So something extraordinary happened. The Federal Reserve Bank of New York called the heads of Wall Street's largest banks into a room. The very competitors LTCM had outsmarted for years, and pressured them to put up billions to rescue the fund. There was no government money, but the message was clear: this cannot be allowed to fail. And so the system that should have punished them instead saved them. The men who bet everything on never being wrong were rescued, not because they were right, but because they were too dangerous to let fall. The fund was quietly wound down, the partners walked away, and some of them, remarkably, went on to do almost the exact same thing again years later. Which tells you something uncomfortable. The lesson was available, they just didn't learn it. Because the trap was never about money or markets or math. It was about certainty. These were not foolish people. They were genuinely among the most intelligent human beings of their generation. Their formula won the highest prize in their field, and none of it saved them. Because what destroyed them wasn't a flaw in the math. It was the feeling of being sure. Intelligence didn't protect them from that feeling. It made it stronger. The smarter you are, the better you get at building arguments for why you're right. And the harder it becomes to hear the part of you whispering that you might be wrong. So here's the only question that matters, and I'd ask you to actually sit with it. Right now, in your work, your money, the people in your life, what are you absolutely certain about? What's the belief you'd defend without checking? Because checking feels insulting. That, the thing you're sure of, is the only place a disaster can ever begin. The geniuses of long-term capital management never saw theirs coming. That was the whole problem. Next week, we go somewhere darker and stranger if this made you think. Subscribe so you don't miss it. Thank you for watching Ruins and Reason.